Hello. Can you hear me okay? Pull up to the scene with the sound risen. Are you able to hear me? I guess not.
I can hear you now.
Oh, okay. Thank you.
Five, 1, 2, 3, 4, 5. When we ran out of time on Friday, we were looking at slide number 33, which was based on exercise 1613. And I realized that the slide did not say how much they had paid for the truck. And problem is, I think that it was based on a prior edition of the textbook. So when I look at exercise 1613 in the current edition, it's a completely different problem. So I'm going to go back to that PowerPoint, do the best we could on that problem. But before we go there, did anybody have comments or questions that we need to discuss first? Okay, then let's take a look at it. You see here the slide. And because it says here depreciation expense 40,000 divided by 4 years, I'm assuming that the amount that was paid for the truck was $40,000. The reason I wanted to go over this is because it's the first exercise we've gone over that has two kinds of tax differences in it. The timing difference and a permanent difference. So timing difference is how they're recording the depreciation, or I should say when they're recording it. And then for the municipal bond interest, the issue is that it is not income at all from the perspective of the IRS. So here we have on their GAAP income statement, if before we count depreciation in the municipal bond income, we have $270,000. And then for GAAP purposes, they would add the municipal bond interest income for $40,000 to give $310,000 of income before the depreciation expense, tax reporting. They don't include the interest income on municipal bonds, so it's not there. Then they record depreciation expense in this year. Straight line method for financial reporting, $40,000 divided by 4 years is $10,000. Double declining balance method for tax return would be $20,000. So then the income before tax for GAAP would be $300,000. Take away the $10,000 depreciation expense. For the IRS, it would be $250,000. Now, for the IRS, you take the $250,000, multiply it by the $100,000, or by the 25%, actually 40% tax rate, because this is the old book. It's not updated, and it's using the old tax rate of 40%. So that's $100,000, and income after tax would be $150,000. Now, if we take a look at the GAAP reporting, it's 40% tax rate times 270 minus the depreciation. We don't include the municipal bond interest because it will never be taxed. So 270 minus 10 is 260. Multiply that by 40% tax rate, and the tax would be $104,000. The $4,000 difference is a timing difference. So GAAP would report income after tax of $196,000. And so the entry to record this, we have a debit to income tax expense for $104,000, because even though they pay $100,000 now, on the income that was taxable this year from an accounting perspective, eventually the tax owed would be $104,000. So the difference is a deferred tax liability, a tax that will be payable later. So questions about that by anybody? Okay, then let's go on to the next slide. It's not too complicated to calculate timing differences when a company has only one expense or revenue account that's affected. However, in real life, a company may have multiple accounts that are affected, and the accounting becomes very complex. So let's look at a company that has 3 timing differences. And so again, this is based on the old textbook with a 40% tax rate, but the principle is still the same now. Pre-tax accounting income of $80,000. They have depreciation deductions that are not yet allowed by GAAP of $60,000. Prepaid expenses that are tax deductible, but not yet GAAP expenses. So GAAP financial accounting says that if you pay for an expense in advance, It's a prepaid asset. It's not an expense until the prepaid asset is eliminated when you get the service later on. Then estimated warranty expenses are not taxable. So the warranty creates a deferred tax asset, while the depreciation and the prepaid expenses create deferred tax liabilities. So the tax on accounting income is 40% times $80,000. That's their pre-tax accounting income. The tax payable on taxable income is it's payable on 15,000. After they take these three timing differences, what they'd report to the IRS is taxable income of $15,000. So the tax on that is $6,000. Then the deferred tax liability is the deferred tax on the 60 and the 17. The 16, 17 times 40% is 30,800. And the deferred tax asset, 40% times 12,000 is 4,800. So the entry to record this would be a debit to income tax expense of 32,000. That's the tax expense that they're eventually going to have to pay on this year's accounting income. Income tax payable is credited for 6,000 because that's the tax that's actually due for this year. Then they record a deferred tax liability for the two accounts of 30,800 and separately record a deferred tax asset of $4,800. It seemed to me that you ought to be able to net the two against each other, but you can't. So questions or comments on that? Okay, then next topic. Is what if the tax rate is going to change? If tax rates are going to change in the future, should the deferred tax asset or liability be based on the current tax rate or the future one? And remember, with this example here, the warranty expenses will be tax deductible in the future. But what we're saying is, if it's not a 40% tax rate in the future, then their deferred tax asset shouldn't be that high. It should be a lower amount. So if the future rate has already been enacted into law, use it. That is, if Congress passed a law saying that taxes will increase or decrease, then that would be the rate that affects your future deferred tax asset or liability. However, proposed or anticipated future rates should not be used. The company doesn't have a crystal ball to predict what the future tax rate is going to be. And what's being discussed in Congress often is completely different when it comes out of Congress. So only if the law has actually passed would they use that to adjust their deferred tax assets and liabilities. Next topic is carrybacks and carry forwards. In order to be able to pay corporate income tax, or to have to pay it, the corporation has to earn income. If the corporation has a loss, they are in no position to pay income taxes. In fact, taxing them could push them into bankruptcy. This could very well ruin the economy. To try to reduce the tax burden on corporations that are having a difficult time, the tax code allows carrybacks and carry forwards. Well, actually, it no longer allows carrybacks, but it used to. A carryback means that a company that lost money this year can combine their loss with the income for the past 2 years to get a tax refund. In other words, if the income for the past 3 years combined, including the most recent one, is low enough, they can get a refund of their past taxes. And when they did the tax reforms a couple years ago, they eliminated carrybacks, but they've kept carry forwards. The carry forward means that a company that lost money this year can apply the loss to future years' profits or gains and subtract the loss from future net income for up to 20 years. And if they haven't made enough profit in 20 years to make up for 1 year's loss, they might as well go out of business. The company cannot use both a carryback and a carry forward. Well, now they can't use a carryback at all. And I'm going to stop that share. Take a look at something else. Okay, I was looking at, I have a more up-to-date PowerPoint, and I believe that that's the one that is posted in Canvas. And so I'm going to take a look at that one right now. So you should be looking at this slide now that says that the 2017 tax reform eliminated carrybacks except for property and casualty insurance companies as well as some farm-related businesses. So it's not been completely eliminated. So here's an example. The company incurred an operating loss of $360,000, both tax and GAAP income before tax during its first year of operations. The enacted tax rate is 25%. They will carry the loss forward, which will reduce future taxes. The current loss can be deducted from future revenues. That would reduce their future taxes by 25% of the $360,000 loss, which would be $90,000. So the entry to record the year's loss would include this entry for $90,000. I said to record the loss, it's not the loss, it's the taxes. They would credit income tax benefit, $90,000, debit deferred tax asset, $90,000. The income tax benefit account is a contra expense account that reduces the amount of loss that's reported. And on their income statement, the bottom part would show this. It would show operating income loss before taxes. So parentheses shows that it's a negative number. Add the, subtract from the loss the income tax benefit. And that means that their net operating loss is smaller because they can apply this loss to future profits, and it'll enable them to pay lower taxes. Okay, so that ends all of the slides on taxes, and we're going to be starting pension accounting now. So there any questions about tax accounting before we get started on pensions? Remember that I've been suggesting that you do the brief exercises before the longer problems for the upcoming chapters. And I started recording brief exercises and problems, and a lot of you are really farther behind in the homework than you should be. So you really need to get cracking. There's not that much time left in the semester, and there's a lot of work to do. So let's go now to pension accounting. Okay, for accounting purposes, there are two kinds of pension plans. And those of you that are in government accounting, we talked about that. First kind is a defined contribution plan. And in a defined contribution plan, the employer promises how much money to invest each period for an employee. Frequently, the employee will also have money taken out of his or her salary, and it will be put into the investment fund as well. So the money is usually sent to an investment firm that will administer the plan. Most businesses and nonprofits use this kind of plan. The accounting's fairly simple. Second kind of pension plan is a defined benefit plan. The employer in this kind of plan has a contract with the employees that has a formula promising how much of a pension an employee will be paid. This kind of plan is usually used by government agencies or unionized businesses. The accounting is very complicated and requires hiring actuaries to do the calculations and estimates. And I've found in the past when I've taught this class that not everybody knew what an actuary was. My cousin was an actuary. So actuaries use skills in mathematics, particularly calculus-based probability and mathematical statistics, but also economics, computer science, finance, and business to help businesses assess the risk of certain events occurring and to formulate policies that minimize the cost of that risk. Actuaries are essential to sponsors of pension plans. Actuaries also address financial questions, including those involving the level of pension contributions required to produce a certain retirement income. So imagine that you worked for a company for 29 years and 11 months. During that time, the company was promising to pay you a pension after you retired. That's a long time. So you're going to retire in 1 month. Today, you got a letter from the company saying they had canceled your pension and were going to pay you nothing. You scream, "But I earned that money. It's mine." Are you right? Or is it just your emotions? Of course you are right. As we saw in the biblical foundations, it's a basic ethical principle that when people work, they have a right to be paid. And a pension is a deferred compensation, meaning that pay that was earned previously was held back in order to be paid later. In fact, the companies administering pension plans almost always deposit the money with a trustee who invests it for the employees. So in a typical pension system, an employer deposits money with a trustee. Employees may deposit additional money with the trustee. The trustee invests the money. In many retirement plans, each employee chooses an investment portfolio. Pension funds belong to the employees. They do not belong to the employer They do not belong to the trustee. The trustee pays the employees their pension after they retire. So here's a diagram. The employer here remits money that goes into the pension plan. The pension plan fund, the company is a trustee, meaning that they take care of money that doesn't belong to them. The employee may invest additional money that goes into the pension plan. The trustee takes the money and invests it in a portfolio for the employee. The employee often will select the investments that are in his or her portfolio. When these investments are made, the interest, dividends, and capital gains are returned to the pension plan trustee, who reinvests them. And then when it's time to retire, the trustee remits the pension proceeds from the fund to the retirees. And that finishes Unit 6. So I want to get started in Unit 7 because we're pretty behind the schedule. And there's a lot to cover before the end of the semester. So the next thing we're going to take a look at is the defined benefit pension liability. The accounting profession debated for a long time about what was the appropriate amount in a defined benefit plan to recognize as the liability for future pension payments. And there were 3 options that they debated that they thought would be the appropriate ones. One is the accumulated benefit obligation that they've already earned. Second was the vested benefit obligation that they've already earned and have the right to take with them. So notice my underlining the difference between 1 and 2 is vested says that if they quit now, they could keep the money. 3, projected benefit obligation that they've already earned, taking into consideration expected future salary increases that would increase that amount. And FASB determined that the amount the company's most likely to owe would be this number 3, projected benefit obligation. And so that's the appropriate measure that FASB requires companies to disclose in their financial statements, as how much they owe their employees for the pension. Defined benefit pension expenses. The routine pension expenses are reported on the income statement as operating expenses. These expenses increase the amount of the PBO. So a pension costs them money, that increases the obligation or liability. There are 5 components that affect pension expense. They're defined on the next few slides and then summarized in a table. The first of these is the service cost. And the service cost is the cost of the pensions earned by employees during the current year. However, since it won't be paid until sometime in the future, the actuary calculates the present value of the future liability. To do that, the actuary has to do number crunching to determine the average amount of time from now until the average employee retires. Second is the interest cost. That's the present value of the expected future pension payments. Or the PBO is that amount. The present value of any liability grows when principal isn't paid because interest is added to the balance owed. So the interest cost is the increase in the present value of the PBO. Interest cost is based on the interest rate estimated by the actuary. Number 3, expected return on plan assets. The expected return on plan assets isn't really an expense, it's a reduction of expense. The more income that the investments in the pension plan earn, the less money the employer will have to fork over to finance the plan. In fact, it's possible that enough money is invested in the plan that it could become self-financing, but that rarely happens. The amount used for the expected return is the actuary's estimated return, not the actual return on the plan assets. So in other words, it's what the plan assets should be earning in the long run. This will help stabilize the amount of expense reported each year. It won't depend on a fluctuating stock market.
So these plans have goals they're required to meet. So, and if they don't meet it through the stock, they have to cover, the company has to cover the expense.
I don't know what you mean by meet it through the stock. Do you mean the stock that's invested in the plan?
The more income investments earn, the less the, what did it say? The less the employer has to pay?
Let's flip ahead to get a bigger picture. And
Goal that they have to reach, otherwise they have to pay it themselves.
right. So here it shows at the beginning of the year, a company had an estimated liability of $800 million. Do you see that, what I'm looking at on the spreadsheet?
Yeah.
Okay, so that's what the actuary said. That's the present value of what they're going to have to pay the employees when they retire sometime in the future. Right now, the plan assets had a fair market value of $600,000 or $600 million. So that means they have not invested enough yet to cover the liability. They're in arrears or a deficit of $200 million. So on the company's balance sheet, they would show a liability of $200 million. Does that answer your question?
Yeah, it does.
Okay. Yeah, part of the problem with this chapter is that there are a lot of interlocking parts, and I have to go into each of the parts in depth to explain what it's all about. And sometimes then you lose sight of the big picture. But this is the big picture that we're heading towards, which is what they're going to be reporting in their financial statements. And so this is really the key amount that a corporation has to report. Now, if they've invested more than the 800, they would show an asset on their balance sheet because they've invested more than they need to, and that would be like a prepaid asset account. That's pretty rare though. Usually it's a liability. And with the federal government, they don't report that liability under federal accounting standards as part of the federal deficit. But it's like $100 trillion for Medicaid and Medicare. Not Medicare, Medicaid and Social Security. Okay, so we got to the third kind of expense that changes the pension expense, expected return. Fourth kind is prior service cost amortization. And a retroactive increase in the pension plan is called a prior service cost. That means that the union would have negotiated a better pension plan with the employer. And not only is the amount that they're going to be earning from now on higher, they've retroactively applied it to years in the past, which means that suddenly the employer owes millions of dollars more in pension than they did before this contract was signed. And so FASB says that you don't have to record that expense all at once, but you can record it gradually over the remaining work life of the employees. So it creates an immediate large increase in the obligation, but the expense is initially reported not as expense on the income statement, but as other comprehensive income. The other comprehensive income is amortized to the income statement over the expected average remaining service life of the employees. Now let me flip back to number 3. This is the long run expected gain on plan assets. It reduces the expense. Amortized losses or gains is number 5. If the actuary changes his or her estimate of either the PBO or the expected return on plan assets, it can create an immediate huge increase or decrease in the amount owed by the employer. This actuarial gain or loss is first reported as OCI. Now, the gains in the long run usually offset the losses, and so the amount that's accumulating in OCI usually remains fairly small. Because if an assumption is made one year that increases the liability, there might be another assumption the next year that decreases it, and so on. So usually the gains and the losses are offsetting each other. If they don't, and the accumulated OCI gets to be too big, they have to amortize it. FASB has defined too big as larger than 10% of the PBO. So if it ever gets bigger than that, then they amortize it over the expected average remaining service life of the employees. Now, I'm throwing a lot at you, but once we start going through the exercises, it shouldn't be that bad. So the pension expense, here's a table that summarizes the 5 factors that are recognized each year. Service cost increases it. Interest on the pension liability increases it. These increases are offset by the return on the plan assets. The cost would be increased if they have to amortize prior service cost. Not every pension plan has that, but if they do, that would be amortized in increased pension cost each year. Then it could increase or decrease by amortized losses or gains from revisions in the estimated liability or in the estimated gains on the investments. Next, we need to look at the 5 factors that change the PBO. 4 of them were already discussed as components of pension expense: service cost, interest cost, prior service cost, actuarial gain or loss. The new factor is payment of benefits. Obviously, if a liability is being paid, its balance will decrease. So when you're paying pensions to employees, the amount you owe employees is smaller. This is summarized in a table here. PBO changes for 5 factors. Service cost increases the amount that's owed. They earn more, you owe them more. Interest increases the present value, so increases the interest, increases the amount owed. Prior service cost, if that's granted, it increases the PBO. The PBO can increase or decrease from changes in assumptions by the actuary, and it decreases when benefits are paid. So we have run to our 40-minute limit, and I need to encourage you to be doing the homework assignments. I just have been looking at how many of you have not been doing them, and it alarms me. I don't know how you're going to catch up at the end of the semester if you don't start doing them. Also, does anybody know what's going on with Cord or Javarsia? They don't seem to be participating in the class anymore.
I don't. Are they here?
No, they didn't log in today.
Oh, I really don't know.
All right. All right. Well,
I have two questions.
okay.
One, do your slides have any information about the journal entries for these plans that we've been talking about?
If you look here,
And then I guess I'll go ahead and say the second question. How often do the actuaries update their estimates?
they do it annually.
Annually? Okay.
Yeah. And now I had in the past on the spreadsheet, it said which accounts were debits and credits, but in this version, it doesn't say that. So I don't have any actual journal entries, but they are definitely in the book.
Okay.
So you can find it there. And if you don't, then we can talk about it in our next session on Wednesday.
Okay, that sounds good.
Anybody else have something they need to ask? Okay, so Friday I was successful in getting the Zoom lecture uploaded to YouTube. So just before we go, I want to go to that website. Okay, so if you're on YouTube and you do a search for Goldsmith Zoom, you should start seeing some of the Zoom presentations that have my name by there. So click on my name and it'll take you to the videos for this semester's courses. So here's the one from Wednesday or from Friday last week. And I'll be uploading the one today, although it takes about 20 minutes to download from the internet to my file and then another half hour to upload to YouTube.
That takes a while.
Yeah, it takes a while. So don't expect to see it right away, maybe not until tomorrow.
Okay.
I know you can't stand the suspense and waiting, but you'll just have to. All right, so I'll see you all on Wednesday.
All right. See ya.
Bye.